Good evening, everyone, and welcome to Shapcott's Accountants Landlord Tax Now and the Future, our autumn property update. I'm glad you could join me this evening for our autumn seminar. Hopefully, you've had an enjoyable day and managed to avoid the rain that we've had, I know, here locally. So today we're going to cover a number of topics, a few in more detail, a few more briefly, depending on whether they're updates or reminders on different bits and pieces. So today we're going to be looking at a few different areas, flipping properties, which is interesting in the current economic and political climate. We're just going to cover property tax credits and universal credits if you're claiming any tax credits at all. We're going to then go on to the reduced rate VAT eligibility. And then we've got, is a limited company the best option? And finally, just a brief update on where we are with making tax digital for landlords specifically. So I'm your host tonight. You can't see me, and I can't see you, but just to give you a bit about me, I'm a property investor myself. We've been investing now for getting on 3.5 years. You can see a few of our projects there. We've just recently finished an 8-bed HMO and a 6-bed HMO for students, which has been interesting in its challenges. So we've got a few refinances that are happening on some of those. I do a number of speaking engagements. We've got something happening tomorrow, and we're looking at different things that we're doing for next year. Now we are starting to unfortunately approach the end of this year. I'm also a director at Shapcott's, who I'm speaking on behalf of this evening. And as you can see, a picture of the family, who 2 young children, not quite as young as that, unfortunately, anymore. So let me jump into our first topic of the evening. If there is any questions you've got throughout the talk, please do send us a message, and hopefully that will come through, so I'll be able to answer any questions that we've got. So the first question I am going to cover tonight is really about flipping properties. So this is very much a buy, do something with it, or maybe even do nothing with it, and sell with the intention of making a profit. Now, there's always a question of how you should structure the purchase and sale, and it really all comes down to intention when it comes to the tax office. Now, many people look at this and decide to do it in their own name as individuals. And one of the nice things about doing it this way is that you get this personal allowance for capital gains tax. So any investment projects, you've got this 12,000 capital gains tax allowance, or around 12,000. However, if you're looking at doing a few projects of this type, rather than buying as an investment, from HMRC's point of view, they'll look at this type of activity and potentially consider it to be trading. So if every year you're looking at doing 2 flips a year in your own name, they will start to look at it and go, well, actually, your intention isn't to buy and invest in it, it's to trade in property, to buy, sell, recoup, buy, sell, recoup, which is arguably a trading activity. It's like having a shop, apart from it's a slightly bigger item you're buying and selling. So from their perspective, they start to look at it as a trading activity. Now, you might think, who cares? What difference does it make? But from a tax point of view, it makes a very, very big difference. So from an income tax point of view, your tax rates are going to be 20, 40% and 45%, depending how much profit you're making on these sort of deals. Now, that's quite significant compared to the capital taxes point of view, which is 18% and 28% for residential property. Therefore, for all activities we're talking about, we'd want them to be classified as a capital transaction, because we get our personal allowance of 12,000, and then anything after that would only be taxed at 18 or 28%. Whereas if they're looking at it from our income tax point of view, if you've already got a job or you've already got other things going on, you may well have used your personal allowance for tax purposes, which in the current tax year is 12,000. So you might have already used that, which therefore means all the profit on this project is suddenly being taxed at 20 or potentially even 40 or 45%, which obviously if you're making 10,000, all of a sudden 4,000 of that has just been wiped out with tax. And obviously as it gets bigger, 20, 30, 40,000, that 40% really starts to bite if you're hitting that sort of area. Now, the tax office may overlook one project. They might kind of look at it, oh, they may be moved, they were thinking of doing something. But if you continue, they will start to get more interested because obviously from their point of view, that's tax that they could be collecting and using rather than you kind of getting all these allowances. So I suppose that leads us to the question, what's the better option? Now, the better option potentially is look at doing these projects through a specific development or flipping company. Now, you might think, why a company? There could be admin hassle. You've got to set up a company, you've got to set up a bank account. There's different liabilities that you may be liable to. But one of the key reasons is there is a tax rate that is a flat 19% on all profits made on a project. So there's none of this when you get over a certain amount, it goes from 20% up to 40%. And if you go to get so many projects, it goes up to 45%. It's literally just a flat 19% on the profits on that project. That's going down to 17% currently as planned. Now, this tax rate is, as you can tell, much lower than the personal tax rate. However, you don't get this personal allowance like you do as an individual. So as a capital gains tax allowance, you get this around 12,000 value. In a company, you don't get that. So the whole balance that you make a profit on will be taxed in full at that rate. Now, when you've got this profit in the company, there are tax efficient ways to take the money out of the company. Or alternatively, if you're just turning around projects and you're looking at capital building, it may be you make a profit, you use that money with the other money you've got to reinvest in the next project to build up your capital pot. If that's the case and you're not taking any money out, literally there is no other tax, there is just that flat 19%, which is great because it just means you're keeping things as low cost as possible. Obviously, if you're looking at taking money out, there is a few different ways you can take things out, like taking dividends out. If you're working on the project full time, you could put a salary through the company. It may be you've put the deposit in, so you can take that out when you want. As you can see, a few different options there. My main advice in this area is just be cautious and do it right so you don't get caught. Over the years, it depends how vigilant the tax office is, and they can actually look back if they think that they should have collected more tax and question what has happened. So just because it goes through, you get no questions, it doesn't mean you're completely out of the woods forever. It may be if you start doing one a year, they look at it and go, that looks more like trading, they're doing that regularly. If you're doing more than one a year, you're definitely starting to go into definite trading areas. And I'd even say if you're doing one a year, you're at risk. If you just do one and do no others, I can't imagine that they'd necessarily start asking too many questions because their resources are limited. So hopefully that gives you a bit of an idea on some flipping and why you may need to consider certain structures for doing that. So let me move on briefly to a topic which is probably not a big topic, but it's just something that if you're claiming tax credits at the moment, you may just need to have an awareness of, because as changes come in over the next few years, things are going to make some changes and have an impact. Now, over the last few months, I've had a few questions, and when we've reviewed the implications, we've actually gone, there is quite significant issues that arrive. So, what are the issues? Now, if you're receiving tax credits and invest in property, you do need to be conscious of any changes that may impact you. For any families that are reliant on tax credits, this is a particularly important thing to be aware of. Now, the tax credit system operates under the approach that it ignores any assets or investments. All it looks at is very much what income are you receiving. Then based on this, it will assess you to determine what tax credits you receive. Now, this means that if you have one property providing an income of 6,000, then this is what you'll report and you'll receive whatever amount is agreed with them. You've got no issues. The universal credit system works on a similar line to the approaches like pension credits. And the key difference that it is it doesn't just take into account your income. It also looks at what assets you hold. The only thing it actually ignores is your own home, or should I say the place you reside in. So that is whether you own it or rent it. It's not, oh, I own one property. It's not a problem if that property is rented out. If you don't live in the property you own, then you still may have an issue. Now, for each person, it allows up to 16,000 of savings or capital assets to be held. And then if it's greater than this amount, you cannot claim. So what does this actually mean? So if we just look at a simple small terraced house, you might say that's worth 100,000. You've got a 75% mortgage, therefore your equity in that property is 25,000. Not a big number. You might think, well, I'm only getting £6,000 from that rental property potentially. At this point, you will no longer be eligible for universal credit because your capital element, your savings, your equity in your property is 25,000. You are now over the 16,000 limit. So that means going forward, you will definitely not get anything. Now, if we look at anyone who's currently claiming tax credits and you're thinking, oh God, what's going to happen now? It's not an immediate problem. They are working through transitional rules, which has transitional protection in place. So as you transition to the new system, you'll not just literally go from one day you get something to the next day, nothing. What will happen is, assuming your circumstances stay the same, you'll be entitled to receive the benefit for up to 12 months after the transition, which is going to be happening from what I've seen recently over the next 2-3 years. The only way it will affect you is if you have to move to universal credits because you have a change in circumstances. Now, if you choose to make a claim for universal credits, you may need to just check whether or not you will be able to claim based on what you've got. Now, a change of circumstances, the issue this brings is it ends your tax credit award. So things like this are you're claiming working tax credits and you lose your job. So then you need to claim you're out of work for universal credit. So then they will look at everything because you're no longer employed, so you lose your tax credits. Now you have to go onto the universal credit system, and then you're assessed under the new criteria. If you're single or you have a family, if you move in with a new partner, if you have a new child, this may impact your claim again, and all of a sudden you move straight away from tax credits to working universal credit, and then from that basis you're into the new scheme. There's no transitional position, you just go from one to the other, and potentially you will lose what you are currently getting. So there is here a few areas where there may be issues, so I'm not going to dwell on it any further. It was really just something to raise the message out there because it's something that's possibly not completely being looked at. And if you're just getting started in property and you're on a lower income and you're looking at doing things, it may have an impact on your cash flow in your household budget. Right, let us move on to something completely different and look at VAT. Not the most exciting of topics, I will say. I did watch something from somebody who got very excited about the topic, and I do applaud him because it can be a little dry sometimes. So let's try and make it as interesting as possible. The reason for talking about reduced rate VAT eligibility is because when you're doing certain types of projects, you may be able to request that your builder only charges you 5% rather than 20%. Now, this is where it gets a little bit interesting, because if you can just suddenly save 15% of your refurb cost, that's definitely something worth looking at. Now, the key thing here is it's normally very useful when you are converting a property from one use to another. So examples would be a single dwelling is being converted into a multiple dwelling, a HMO. Now, all the information I'm going to cover this evening is contained in VAT Notice 708, the Buildings and Construction one, which can be useful if you're getting into property or you are in property to make sure that you have an awareness of this one, because this is the one that impacts what you can, what you can't claim, and a few different areas, especially when you're doing conversions, whether resi to commercial, whether single dwelling to multiple, whether multiple back to single. So there is a few things, and we'll go through a couple of examples in a minute just to help hopefully make it all make sense. So let us have a look at the qualifying conditions for this reduced rating. Obviously, the first thing is they have to be a VAT registered contractor. So your builder, your plumber, your electrician, whoever it may be, they need to be VAT registered. If they're not charging VAT, so there's no saving. Now, the basic conditions are as follows. So we've got a qualifying conversion is carried out. You provide a valid certificate, and then the services being provided by the contractor are qualifying services. So let's take each of those one step at a time. So first of all, what's a qualifying conversion? Now, I've got a bit of a table to show us what we have got. So a single dwelling to a single dwelling isn't going to have any ability to reduce the number. However, you might be able to do a single dwelling to multiple single dwellings because you may be splitting something up. Now, there is availability when you're doing single to multiple, and there's single to relevant residential purpose building, which I'm just going to not cover today on the basis we've only got limited time and I don't want to get too technical on it. But if you're doing something that's not a residential property but may have residential purpose, so there's things like care homes, there's large dormitories, there's all sorts of different things which are residential but not just multiple dwellings or single dwellings. So if you do need things, that is all in that VAT Notice 708, which goes into a bit more detail on those. So we've got multiple dwellings to single dwellings, but a multiple to a multiple is not particularly a qualifying one because it's already that and you're not converting it to something different. Relevant residential, again, we're okay, and a relevant one to a single household or a multiple is okay, but not relevant to a relevant. So hopefully you can kind of see if you're keeping it the same, no. If you're moving it to a different category, you can probably get a reduced rating. A building that's never been lived in or has not been lived in, has been empty for a number of years, may also qualify for this sort of conversion. So conversions into a single household dwelling. Now, the qualifying conversion includes things like a property never lived in, multiple occupancy, things like pubs. It does not include the creation of a living accommodation such as a granny annex or additional bedrooms at a care home, and it doesn't allow for just renovation or alteration of living accommodation. So there is a few things it doesn't include, there is a few things it does include. So if you're looking at something like this, you may just want to have a look at that 708 notice, and section 7 is the area which goes into great detail about it. So let's just kind of give you a couple of examples of converting and refurbishing. And these examples can be seen in the VAT notice as well. So if you do want to follow up and read up about it, it will just hopefully start to make a bit more sense. So the first example that HMRC have given us is a block of flats consisting of 4 floors, each with 4 flats. So a lift is installed and work is carried out throughout the whole building. Now on the ground floor, we've got the first floor and second floor. The footprint of each flat is changed to take account of the new lift. Now this results in a change in the configuration of each flat, and on the 3rd floor, a penthouse flat is created from the original 4. So although the number of single household dwellings in the building has changed, only the work to the 3rd floor would be eligible for the reduced rating, because it's only that part of the building that has had the number of dwellings changed. So the fact that you've still got 4 flats on each floor, it doesn't matter. It's just the top floor that's arguably gone from 4 flats to 1 penthouse, and the other floors haven't arguably been changed apart from a layout because of fitting a lift in. So if we kind of move on with the same example, but instead of just the top floor, we've now got the 3rd floor has actually merged 2 of the flats. So instead of 4, we've now got 2. That arguably would now allow for reduced rating. So then if we kind of took the ground floor as well and made that 5 flats instead of 4 flats, again, the overall number of dwellings has not changed, but it's been reconfigured. So as you can see, you might have a whole building and tweak things. So certain areas will be allowable, certain areas won't be. If you buy a residential 3-bed property and turn it into a 5-bed HMO, that, yes, it will. If you're buying a block of flats and tweaking things around, if you're not changing the number of dwellings, you might not be able to. But if you're completely rejigging the whole building with different number of flats on different floors, you probably can. If you're doing a bit in the middle, some floors you're changing, some floors you're not, some of it may be allowable on the reduced rate and other bits won't be. So then that kind of covers, hopefully, that sort of area. So that leads us on to the second bit, which I've not got a slide for because it's a valid certificate. Now, in paragraph 18 of the VAT Notice 708, there are some example certificates. For this sort of work, if it does qualify, I'd just go to those certificates, download a copy, tweak them to make sure it applies to your refurb, your work, the conversion work you're having to do, provide that to your contractor, and then that gives them the evidence they need to reduce rate your work that they're doing for you. So let's look at the final condition of what actual work is included. So generally what is included that can be qualified for this reduced rating is arguably work to the building, the structure of the building. So if you're moving walls, if you're putting on a new roof, if you're redecorating, repairing, improving, putting new windows, it's basically anything to that fabric of the building. You can also reduce rate any works that you're doing to water, drainage, waste disposal, heating, all that sort of thing. So there's quite a lot of different options of what you can, assuming your contractor is VAT registered. There are some services that you cannot reduce rate. So these include things such as installations that are not goods that are not building materials. So I'm talking here carpets, bedroom furniture, scaffolding, the hire of goods, landscaping, professional services, so architects, surveyors, and that sort of thing. So they are just not allowable. Now, if you have some work that is going to be reduced rateable, I should say, which is possibly not aware, and have some that is allowable, you may need to get them to invoice separately or split it on the invoice, because The apportionment works on the basis that if you split it out and you apportion it on a fair and reasonable basis, they can 5% some of it, they can standard rate some of the other work. If you decide not to make the apportionment, then none of the work can be reduced rated and it's all got to be at the standard rate of VAT. So maybe you need to get things separated out to make sure that obviously everything is fitting together. Now, one thing just to cover on garages. So you can reduce rate the conversion of an outbuilding into a garage, construction of a new detached garage, or construction of a drive serving the garage. Now, this is provided that the conditions are met, that the garage is intended to be occupied with the single dwelling, multiple occupation, or the premises intended resulting from that qualifying conversion. And the work is carried out at the same time as the qualifying conversion. So if you do it 6, 9, 12 months later, it doesn't qualify. If you do it as part of your refurbishment project, you can include it. The one thing you cannot reduce rate is the provision of a hard standing, which is arguably ground surfaced with a hard material for vehicles on. The only exception is if it's also used as access. So it might be it's for the cars to park on, but it's also the entryway, the path to the property. So if that's the case, you'd be able to claim it. If that's not the case, then it would just be the normal standard rate of VAT. So hopefully that gives you a bit more awareness of what you may or may not be able to claim. We've previously covered actually the reality of how you go about doing it. So if you want to find out a bit more, do drop us an email and we can send you the link to our previous video, which covered arguably the other half of things, which is how it works in practice. Today we kind of focus really on the eligibility of what you can and cannot reduce the VAT rate on. So let me move on to a different topic. Is a limited company the best option? So on here, we're kind of looking at what are the options. Now, the answer to this question, unfortunately, is always, and it depends on the circumstances. However, there are some general principles that we can look at when considering this to help make a decision. Now, these questions are things like, are you a high rate taxpayer, additional rate taxpayer, or not? Now, if you're a high rate taxpayer, most things are going to be more efficient within a company, just by the simple fact the tax rates in a company are that much lower. So if you're in a job, you're working, you're paying 40% tax, and you're looking at investing in property, you're probably going with, it may be good to jump in with a corporate structure straight away, because by doing that, you'll move everything out so the company will get taxed, and if you're reinvesting your profits early on, then it means that actually you're going to be kind of keeping your tax bill down to as minimum as possible. You can still take dividends out, assuming you're not getting any from anywhere else, because you can take the £2,000 at 0%, whatever your income. So there is still ways to get your money out of the company, but it's just maybe it keeps that tax bill down, because I'd hate for someone to be paying 40% tax when they could have been paying 19%. Obviously, if you're a basic rate taxpayer at 20%, it's kind of relatively similar. So if you're only earning 20,000, you could actually put a few things in your own name as an option. It really depends what your plan is moving forward and your intentions. Now, will any of the rental income take you into being a high rate taxpayer? So you might not be one at the moment. You might have a salary at 20 or 30,000, but all of a sudden, if you've got 1 or 2 rental properties, you may be getting 6, 7, 7.5, 8,000 on them a year. All of a sudden, if you're at 30, just over 30,000, you go 30,000 plus 8 is 38, plus 8 is 46. The current threshold's 50,000. So on that basis, that 50,000 is not very far away. So if you were to get another one, it would definitely tilt you over. If you got a pay rise in your job and you go up to maybe not just 30,000, but you go up to 35,000, all of a sudden that 16,000 you've got has taken you to 51,000. So now you're a high rate taxpayer. So it's just certain things to contemplate, because I know I've spoken to a few people who are like, I've got this salary, but I'm expecting a pay rise to something like this. Take these things into consideration, because they may have an impact on what direction you go for. Now, how are you going to buy the property becomes a real question. Are you funding it by debt? Are you buying it cash? Now, this can have an impact on how it's taxed, on how it all fits together. For one thing, if you're buying a property cash, it kind of doesn't matter in some ways which you go for. You could buy it in your own name, you could buy it through a company and inject the money into the company and then buy it through the corporate structure. The company at some point would then just repay that money to you when it's available to either reinvest or take back out to do something else with it. Now, in terms of if you're going to get a mortgage, now this may be a direction that you have to look at what the broker says and what mortgages or funding you can get to decide on your corporate or personal landlord structure. Because if you can't get a mortgage in a company, if it's your first project, because they go, it's too risky, we don't like it, you've got no experience, you may have to buy in your own name, even if it's not tax efficient at the moment to do it that way. But by doing that, you get the experience so that your next project you can buy in a corporate structure, which therefore means you get better rates. But if you hadn't done the one in your own name, you wouldn't have even got off the starting block. So there is a few things here which is practicalities as well as tax efficiencies. And it's just finding where that balance is. So it's very much working with your accountant, your tax advisor, with your broker, and making sure your financial advisor's on the scene as well, so that everything can be done with the right sort of planning in place and make it happen. What are your future plans? Are you keeping? Are you expanding? Are you selling? What are you planning on doing? One question that, if you've ever spoken to me, is what are you planning to do? Where are you planning on going? What are your future intentions? It's always a question I ask. If you're a high rate taxpayer, but in the next 2 years you're looking at quitting your job, sacking your boss, and moving things forward in that direction, then you might go, actually, I'm going to put things in my own name, because in 2 years I'm not going to have this salary. So on that basis, I won't be a high rate taxpayer, and I don't mind paying the tax for a year or two, because over the lifetime of this asset, the lifetime of owning it, it's kind of more beneficial for me to have it in my own name, because when I do come to sell it, I'll get my capital gains tax allowance, I'll get a few benefits from doing it that way. I can put it in my husband's name or spouse's name when I come to sell it. So therefore we get 2 lots of capital gains tax relief. So as long as you don't make a profit of more than 24,000, you won't pay any tax. And if you do go over that, you'll pay 18 or 28% on it, which might be more tax efficient than putting it through a company and holding it through a company and having to pay more tax that way. So there is a few considerations to make. As you can see, it's not quite a, if you do this, this is the answer. If you do this, this is the answer. It's really just having a look at what your intentions are, how you can actually get this started, because sometimes that might dictate the direction you have to take. It's looking at how are you going to fund things, how can we get our money, are we planning on being in exactly this position in the future, or are things going to change, and let's plan for that change so it makes sense in 2-3 years of where things are. Obviously, intentions change, governments change, as we may see soon. So all you can do is plan for now based on your current intentions. So don't think, oh, I got it all wrong in a year or two's time, because when you made the decision now, That was based on your knowledge, your understanding, how you were seeing things today. Obviously, as things change, as your intentions tweak, that's where you just need to review, how are we doing it? How do we change? Is there anything else we need to be looking at? Just because you go down a corporate structure doesn't mean you have to continue doing that. You might buy in a company and then you stop working, and then you start buying a few in your own name, and then when it works through, you start buying in a company again. Or you might start in your own name and get to a certain point and then go, oh, it's probably more efficient to do it in a company now. So it's not I've made my decision, this is the route I'm taking. Thankfully, it is quite a flexible approach. So it's just making sure you're making those considerations as you develop through your own journey. Obviously, when you're making these decisions, you do need to consider the cost implications. Having a company does tend to cost a little more money because of greater accountancy costs, but then hopefully the tax savings benefit you. So overall, you are better off that you're getting more money into your household. The key thing for me for a lot of the time is looking at how much money you're going to be getting into your pockets, because that's obviously what is important to you and allows you to have a nice, happy lifestyle that you are wanting. So hopefully that's given you a bit of a few ideas of things to think about when looking at, is limited the right option? For some people, definitely. For other people, definitely not. For other people, it's kind of on the fence, and it comes down to a personal decision of how you want to proceed with different things. So let me move on to my final topic of the evening, which is just really a brief one because not a lot's changed, but it is still coming. I've been saying that all year this year, but it is coming. And what the key thing is things are going to have to be recorded digitally. You're going to have to keep your records, and you will have to submit things on a regular basis. Now, until earlier this year, that was going to be coming in April 2020. The authorities have now confirmed that they're not going to be introducing anything new in 2020. So that means making tax digital for income tax for landlords will not be happening next year, which is probably a positive thing because it means we've got more time. It means that you've not got to make any changes immediately. However, it is coming, and it's probably going to be 2021. It may be pushed back to 2022. So it's just something to have in the back of your mind that you will need to do something on a digital basis. Now, when I say digital, it could be a spreadsheet if you've just got one or two properties, maybe 1, 2, or 3. If you're getting more complicated, I'd definitely be saying that you should potentially be looking at something like QuickBooks Online, who we work with, something like Xero, who again we also work with, and some of these different ones like that, where they'll give you quite a lot of information. You can use things like bank feeds to make it easy so you can keep track that you've had your rent in for the month, that all the bills have gone out, what you've got left over, how profitable the properties have been. So if you're not using anything at the moment, that's not a problem. It's just something you may have to start using something coming up to the end of next year, the beginning of 2021. And I'd probably say if you're thinking of doing something, make sure you get set up so it's ready for these changes that are coming. It's just not yet, but we're not that far away. Now, other bits I just wanted to mention this evening. We've got a Shapcot smartphone app, which is available for free. So if you want kind of the latest on all the tax rates, there's a mileage counter on there. There's a few different features. So if you're interested in having access to that, just download it from the App Store or Google Play. We will be hosting our winter property webinar on Thursday, December the 12th of December, a couple of weeks before Christmas. And also we will be hosting a specialist webinar in November, which is going to be targeted on HMOs. So if you are investing in HMOs or thinking about investing in HMOs, that webinar will be great for you because it will literally cover what you need to know specifically on setting up, structuring things for a HMO, looking at how to deal with things, what expenses you can claim, how everything's dealt with, and the longer term of running your company with your HMOs in there. So on that basis, it's kind of about hopefully tax, accounts, everything to do with HMOs, so that you know what's happening and what's going on with them from an accountancy and tax perspective. So if you are interested in that, drop us an email, send us a message, and we'll make sure that as the date's released for that one in November, that you are on the list so you can get registered and come along to that one if it's of interest. So thank you for listening today. If we can be of any assistance, we offer free consultations to chat through different bits and pieces. So give us a call and we can just chat through your situation and hopefully try and assist. And we offer rental income packages, which are fixed fee packages, which cover off all the compliance, can help with advice, planning and bits and pieces, which hopefully help make sure that you're making the most out of your rental income and getting the most in your pockets rather than the taxman's pockets. Now, let me just see if I've got any questions. So I've just got one question about flipping property, which is, so based on what we've mentioned tonight, for most people, if you're looking at doing it as a trade, would it be right in saying that you should go limited? My advice is, if you're looking at doing it as a regular activity, if it's something that you're wanting to be doing 1 a year, 2 a year, I would definitely be suggesting you put it through a corporate entity, a limited company, as this way you'll ensure you're compliant with all the tax laws. You've not got to look behind your shoulder to find that in a couple of years the taxman comes and has a look at things and goes, well, actually, we think you're trading and you owe us X amount of money plus penalties because we don't think you declared it correctly. So if you're just doing one, you can probably put it through your own name. If you're doing more than one, or if you're thinking we're just doing one at the moment, but we want to keep going with this one, we've done this one, I definitely suggest going through a corporate structure. Nicely, if you do it through a company and you've got a rental portfolio as well in potentially another company, you can move that capital from one company to another company and there's no tax implications for that. So if you generate 20, 30,000 profit on your flip, you can then send that over to your rental portfolio company and there's your deposit for your next rental property. So it's just a nice way of structuring things, with getting things, generating capital and then using that capital to increase your asset base and move things forward. So I would probably recommend going down that route, definitely, if you're looking at doing that as a long-term strategy, just to make sure you don't find that you've got issues in the years to come. Okay, well, thank you for listening tonight. I wish you all a great evening and I hope to see you on our HMO webinar in November, or if not, I will see you in our winter webinar in December. Enjoy the rest of your evening.